Many of my longtime subscribers have noticed an evolution in my thinking over the years. It's true, although I do view much of modern financial theory as being suspect, I have embraced one of the concepts proposed by Harry Markowitz in his 1952 dissertation on portfolio selection. The concept was that a diverse group of assets can be less volatile and hence more predictable than the sum of its parts. I believe strongly that since nobody can predict the future, and I mean nobody, that everyone is well served by considering buying a carefully selected mix of assets. I like to think that my contribution to the field of modern portfolio theory is the discovery that the negative correlation between gold and financial assets increases over time. Thus, although in single years gold and financial assets are roughly uncorrelated, over holding periods of 3 to 5 years or more, gold becomes considerably more anti-correlated to financial assets. I don't think anyone in the mainstream financial world has noticed this, which may be why most of them are so antagonistic towards the idea of using gold in a portfolio. But I have determined that gold becomes very effective insurance against poor performance in financial markets, and conversely, financial assets can be good insurance against poor performance in gold. This is incredibly important for anyone who may need to liquidate a portion of their portfolio over the span of a few years. It means that when the money is needed, it is more likely to be there, whereas if all of a person's funds are stored in a single asset class, it would be mostly up to the fates to decide if the investor will sell at favorable prices or unfavorable prices. This can be clearly illustrated here, where I show various 10-year performance data for gold on the x-axis going back to 1971, and the performance of 10-year Treasury bonds and the S&P 500 over the same 10-year periods of time on the y-axis. You can easily see the correlations that exist. When stocks and bonds perform worse than average, gold performs much better than average. When stocks and bonds perform very well, gold performs worse than average. This information led me to invent the 35% gold and 65% US stock portfolio. I have observed and have shown the very predictable performance of this portfolio in many of my videos. It's the portfolio that I personally rely upon for protecting and growing my own wealth. Many have asked me some very good questions about this portfolio. One question was whether or not such an approach would work with international stocks. In one of my videos, I did show that it works well and that the optimal mix is roughly the same. Others have asked about silver, and I pointed them to some of my old videos where I showed that due to silver's volatility, it did not do as good a job at stabilizing portfolio performance. Lately, I have received questions about adding platinum and real estate into the mix. I thought these were very good questions, and so I picked up the gauntlet and crunched some numbers. For the slides that follow, I'm going to use the Wilshire U.S. Real Estate Index as my proxy for the real estate market. It was the longest running comprehensive data set for U.S. real estate, and I was able to locate it easily. This data set goes back to 1978, and so I will consider all of the data for U.S. real estate, the S&P 500, the EAFE Equity Index for international equities, gold, silver, and platinum for the same timescale. As I have done in the past, I will consider only the performance over several years, combined in light of my discovery that gold's negative correlation grows strongly over multiple years. Now, this required me to build my own mean variance optimizer, but that wasn't too hard to do. Besides, it gave me something to do while I was bored. Let's walk through my findings. What you are seeing here is the performance of various portfolios relative to the return of the 5-year U.S. Treasury note. On the y-axis is the average total 5-year return in excess of the 5-year Treasury. On the x-axis is the standard deviation of all of the 5-year return periods from 1978 until today. Individual assets are plotted as dots. The green dot at the origin represents the 5-year Treasury note. The reason it is at the origin is because all of the data is being expressed relative to the Treasury note, thus it serves as the benchmark. You can see the various other dots. Over this time period, gold, plotted as a dark yellow circle, provided on average about 1.5% more over every 5-year period than the Treasury note did. Silver and platinum lagged behind the 5-year note by a few percentage points on average, silver by about 4% and platinum by about 8%. Note these aren't yearly return differences. These are 5-year return differences. So overall, gold, silver, and platinum performed close to in line with the 5-year Treasury, albeit with significantly greater variability. The S&P 500 is plotted as an orange dot, the EAFE International Equity Index is plotted as a purple dot, and the Wilshire US Real Estate Index is plotted as a red dot. All three outperformed the 5-year note on average, as can be expected. The S&P 500 and U.S. real estate markets beat the 5-year Treasury on average by about 50% over a 5-year period. This is pretty significant outperformance. The EAFE outperformed only by about 40%, which is still respectable, but came at much greater variability in performance. Now here's where the magic comes in. Let's combine all of these assets into what are called optimal portfolios. What is an optimal portfolio? It is the mix of assets that provides the highest level of return for each level of risk. What is shown here as a blue curve is referred to as an efficient frontier. Each point on this curve is a unique blend of all of these assets that provides the best observed return for each level of observed variability. The point to the far left is the minimum variability portfolio. It consisted roughly of 9% real estate, 47% S&P 500, 3.5% EAFE equity, 22.5% gold, and 18% platinum. On average, this portfolio generated 5-year returns that were about 28% higher than the 5-year Treasury. Of course, there is no such thing as a free lunch. This excess return did come with the cost of variability, but nobody here is going to have a problem with that. As we move towards the right, the excess return starts to go up. This is because we are gradually increasing the amount of equities and real estate in the portfolio. I found it interesting that the Wilshire US Real Estate Index is actually an efficient portfolio and is at the far right-hand side. That means that at the level of risk of the US real estate, there is nothing that can be blended with it to increase its level of return at its given level of risk. Also, for the level of return seen in the real estate market, there is nothing that can be blended with it to bring down the level of risk without sacrificing return. Make no mistake though, this is not to say that the US real estate market by itself is the best asset to own, especially in isolation. And it's not, as I'll show you in a minute. Let's now add my 65% 35% portfolio to the chart and also add a point that I think might be even better if real estate is considered. The green star is my 65% 35% portfolio. One can see that it's not optimal. Its 5-year returns on average fall about 5% below a portfolio consisting of 25% US real estate, 50% large US stocks, and 25% gold. So it will lag by about 1% per year. Still, over the 1978 to 2020 timeframe, its performance is not too bad. Now, why am I putting a portfolio of 25% real estate, 50% US stocks, and 25% gold on this chart? Well, why am I picking this point at the exclusion of the others? It has to do with another concept of modern portfolio theory called tangency. Let's put a line on this chart that goes through the origin and is tangent to the efficient frontier. And here's the tangency line. Now, what's so special about the point of tangency? Well, let's say that you were comfortable with S&P 500 levels of risk, but wanted higher returns. According to the efficient frontier, you might be able to get a little bit higher return by blending in real estate. In fact, a 78% real estate and 22% US stock portfolio will have the same amount of variability, but will outperform by a fraction of a percent per year. But why stop there? Why not take advantage of the fact that money can be borrowed? We can simply short the 5-year Treasury and use the money to invest in the portfolio represented by the blue star. When we do this, we find out that we can generate much higher returns than the S&P 500 at the same level of variability simply through the use of leverage. Now, this is not something that I'd personally be comfortable doing, but many financial professionals are. And this is why I say that a pure real estate portfolio is not truly optimal. Even though it's efficient, there are ways to use greater leverage to enhance the returns available from real estate at the same level of portfolio variability. Doing so requires a person to blend in some gold and some stocks. So there you have it. When I extended the list of available assets to include international equity, real estate, platinum, and silver, what I find is that there is a more efficient portfolio than my 35% gold and 65% stock portfolio, at least for this time period selected. Is the added complexity worth it? Well, that's something that you'll have to decide for yourself. 1% per year over a couple of years is not incredibly significant, but 1% per year over a couple of decades can be quite meaningful. Now, if you liked this video, please hit the like button down below. It will help the YouTube algorithm decide to promote this video to others. And please also comment below and consider forwarding the link of the video to others. So thanks for your attention, everybody. I look forward to interacting with you in the comments section.